All right, welcome YouTube. Sorry other apps are going to hear a little bit of a repeat, but today on this live, I'm going to talk about ways to make money in real estate in 2023. I'm going to start out macro and work my way micro and more granular. We're going to talk about wholesaling and how to do that briefly and how to do it in today's market. We're going to talk about fixing and flipping and a few strategies that you can implement to be better at it in today's market. And then we're going to really dig deep into rentals. That's what she said. We're going to go deep. We're going to talk about, and we're going to talk about, how to acquire these properties and how to make them cash flow for long-term tenants. But then we're even going to talk about some different rental strategies to help you cash flow if you don't want to go the long-term route. The short-term rentals most people know about, we'll touch on that, but we're also going to talk about mid-term rentals, which may be a new term to many of you, may not be. Regardless, it's going to be an action-packed, full of information-packed live. So thank you for being here. Whatever platform you're watching, if there's a like or a share or a double tap button, please do that. I'm going to introduce myself for the last time and then get the ball rolling because I already did that for the other platform. So my name is Sam. I'm a real estate investor. I own a $42 million rental portfolio that I bought without using any of my own money. I also own a house buying company that flips over 300 houses a year. When I say flip, I mean wholesale and fix and flip. And then I also have about 2.1 million followers here on social media. So I do a lot in the real estate space, and I've been able to garner somewhat of a following and somewhat of a brand because the information I give out is next level, and most people charge thousands for it, and I get away for free. I digress. On to make money in real estate. So the first way is wholesaling. Raise your hand, give me a thumbs up, say something in the chat box if you have wholesaled before. Throw that in the chat box. Let me know where you're from if you haven't. That's always kind of nice just to see where the audience is at. But wholesaling is a great thing for new investors. Let's talk about the pros and cons of wholesaling, and then I'll slide in how 2023 is going to affect that, and then we'll move on to fix and flips because obviously it doesn't apply to everybody. However, if you're a fix and flipper, if you buy rentals, if you're Airbnb arbitrage, if whatever you do, wholesaling should be part of that. Like you should wholesale because it's such a great way to make extra money with no risk and no money and no credit. So it can be your focus, or you should at least know about it. So when you do invest and do other things, if you come across a good wholesale deal, you can monetize it and make a lot of money on it because there's a lot of money to be made. And if you're doing those other things like fixing and flipping and rental, you're going to come across wholesale deals. So don't let them die or don't push them off to the side. Use them and monetize them. So what wholesaling is wholesaling is basically acting as an intermediary between a distressed house seller and a real estate investor. A distressed house seller wants to sell their house quick for cash. A real estate investor wants to buy distressed houses for cash. They don't always usually meet because real estate investors are doing other things, have full-time jobs, whatever it may be. And these distressed home sellers don't want people in their house. They don't want to blast their house over the internet. They don't want people to know how distressed their property is or how distressed they are. It's usually a personal issue with them or the house going on, right? So they don't usually meet that often. So what a wholesaler does is he connects the two. She finds a distressed property through multiple channels. We're not going to go into today. They find that and then they get that property under contract and then they sell that contract to a real estate investor. So they're making connections. They're connecting with distressed sellers and they're connecting with real estate investors, and then you can get paid $10, $15, $20, $30, $50,000 to do so. It's kind of like being an agent, but for an investor. So that's wholesaling in a nutshell. How you do it in 2023 is wholesaling is going to be more and more prevalent this year than it was last year even. Last couple of years, everybody on social media was wholesaling and wholesaling experts. That's fine. That's great. Not very many of them were, but more power to them getting their brand out on social media. Those people are kind of going away, as is the fly-by-nighters, the weekend warriors, the people that have full-time jobs that are wanting to wholesale a couple houses a year or find just a couple distressed houses a year. They're going away. That's what happens when markets shift. People get uncertain, people get scared, and people leave that industry and focus on whatever their actual day job is, most likely. So there's going to be better deals in 2023 now. The backside of it, the after repair value, the fixed up value is probably declining a little bit, but just adjust that when you're buying. If you used to buy at 75% of value minus repairs, if you're a wholesaler, now buy at 65% of value minus repairs in case that value dips a little bit and still leave yourself enough meat on the bone for you to make money as well as the investor you're selling the property to make money. So wholesaling is great. In the past, it works in any market, any city, any state. Works in LA, works in New York, works in Missouri, works in Wisconsin, works in Florida, works in Texas, works in Alaska, works in California, works in, I might have said that already, works in Hawaii, works everywhere. And you can do it with no risk if you have contingencies in there. Again, I'm trying to keep the surface level here, and we're going to get a little more granular as we go. But if I say things you don't understand, or if I say things you want to know more information about, I literally have probably close to 10,000 hours of free content on social media between my YouTube, my TikTok, my Instagram, my Facebook, my Twitter, my LinkedIn, everything in my podcast. There is endless content that you cannot even binge all in a month. There's enough content for you to binge forever because I'm continually making content. So make sure you're following me at Sam Faster Freedom on whatever platforms are your favorite and the Faster Freedom Show podcast. All right, so that's wholesaling. We're going to move on from that. It's a great strategy for newbies, and I have a ton of content on it. And I'm going to make more content on it because I think it's going to be big in 2023. All right, fixing and flipping is the next one I want to chat about. Fixing and flipping is simple. Raise your hand, thumbs up if you're either fix and flip or interested in fixing and flipping. Again, double tap those screens. Give this video a like. Like on TikTok, I've had people double tap the screen and I got 100,000 likes. I think the most likes I've ever gotten on a live on YouTube has been like 20. So people are a little stingier with that like button on YouTube. But anyways, fix and flip is getting a property under contract, potentially from a wholesaler that's distressed, fixing it up, and then selling it, hopefully for more than you bought it, and fix it up for whatever's left over is profit. You may have to split that with the lender or give a portion of that to a lender, but the rest of that is your profit. This is a big thing. This is what most people think of when they think of real estate investing because of those shows on HGTV and those shows that you see, on A&E or whatever platforms all these fix and flip shows are. It's really cool to see that distressed house come to life and then, sell it or live in it. So fixing and flipping is something that we're doubling down on in 2023 as opposed to 2022. Our plan is to do 3 times more flips in 2023 than we did in 2022. I think mainly because some of that competition is going away. Good houses still sell. If we spend extra money and extra time and effort on a rehab and put out a quality product, the supply is still so low of quality products that our houses are selling for over asking. We had a condo last weekend. The most a condo had ever sold for in the height of 2021 in this area was $295,000. The highest a condo had ever sold. It's just a condo we're talking about, and it's in St. Louis. We put out a really, really quality product, listed it at $299,000. We got an all cash offer for $305,000. So again, we're not getting $50,000 over asking, but we've got all cash, no contingencies, $10,000 more than any condo had ever sold in that little complex or big complex before, and over asking. So if you put out a quality product, you're still going to sell. So we're planning to put out quality products. The supply of condos, of houses is still so low, they cannot build enough houses. If everybody doubled down their house building, it would still take several years, if not a decade, to catch back up. I think Fannie Mae doesn't think we'll be caught up on houses until like the early 2030s. So we still have a lot of work to do for houses as far as especially quality houses. So if you're going to fix and flip, today's a great market to fix and flip in. Be careful. The house prices are dipping. They're dipping because they spiked so quickly. So naturally, it's usually like this. We had that huge spike. So we get a little bit of a dip. We're still on that spotted line of quality growth, and then we're probably going to play with that line. That's what I predicted over the past 12 to 18 months. Huge spike, slight dip, back to normal. We've already had that slight dip. Some markets are going to continue to dip a little bit. Some probably are not. But regardless, that is a whole, taking all of real estate into account, not high quality flips. High quality flips will still sell. They will still sell for asking or higher if you're asking a fair amount. So fix and flips, still do them. If you want private lenders or hard money lenders, make sure to let me know in the chat box. If you're on Instagram, I just have this new thing. If you interact with this Instagram live at all, I should send you a free training. It should automatically send. So I'm the one in my DMs. You want to have a conversation, it's me. However, if you're interacting with this or you send me a keyword like new or training or something, you will automatically get a free training. And then anything beyond that is me responding. But I set that up because I literally have spent hours a day copying and pasting free trainings over to people. So I automated that part, but I'm still the one in answering. There's nobody else in my DMs. So fixing and flipping is a great strategy still. Now let's get into rentals, okay? Because this is the one that I want to do that deep dive on, how to buy rentals, how to make money in real estate in 2023, specifically how to buy rentals. So let's talk about some strategies for long-term rentals as far as cash flowing, and then let's talk about some strategies for midterm and short-term rentals, because you might be surprised you can do midterm and short-term rentals if you want. One listening, what's up? Whoever's listening on Twitter. All right, here we go. So let's talk about some strategies that I've talked about quite a bit recently. The first strategy when you are wanting to cash flow a rental property, specifically with the BRRRR method, and interest rates are higher, so it's harder to cash flow. You're paying more in interest, therefore you're cash flowing less. So let's talk about how to help mitigate that. The first thing you do is shop banks. I have literally in the past 2 months, several times, been quoted 3 separate rates at 3 separate banks. Last time I remember the numbers, it was a couple months ago. I was quoted like 6.25%. I was quoted like 7.25%, and I was quoted like 7.85% at the same time from 3 separate banks. So shop banks. Interest rates matter. Usually I would just go with whatever banks because they were all kind of doing the same thing. Now some are trying to make more money, some are over leveraged, some are trying to make money while they can. Others are trying to mitigate all the really cheap loans they've given out recently. But shop banks, it makes a huge difference. If you do one of these things, you might not cash flow as much. But if you're able to do all 4 of these things, 5 of these things, I think you can cash flow close to what you were cash flowing before, if not more. So number 1, shop rates. Number 2 is check your amortization schedules. That's supposed to say AM schedules. So what does that mean? Anybody know what amortization schedule means? Throw it in the chat box if you do or don't. But check your amortization schedule, because a lot of people are like, I want to pay off. Cash flow is easy right now. I can still cash flow, and I want to pay off these properties as quickly as possible. I want to do 15-year mortgages, meaning in 15 years it'll be paid off, so the monthly payment's more, but it was still able to cash flow. Don't do that right now. If you still want to buy rental properties, cash flow is important. Cash flow is not a wealth creator, it's a lifestyle creator or a debt pay down tool, but it's not something to live on. So I don't worry about cash flow, and I don't think you should either, in my opinion. So do 25-year mortgages. The difference on a 15-year and a 25-year mortgage is very, very high when it comes to your monthly payment. So if you do a 15-year mortgage, your monthly payment's probably going to be, I don't know, depending on the property, like $800. If you do a 25-year mortgage, it's probably like $600 or $650. So that's a couple $100 you can save, or at least $100 for going for 15 to 25 years on your amortization schedule. And then if interest rates dip a little bit, then you can always, refinance and get that rate a little bit lower. So amortization schedule, stretch it out, or use your personal name to buy the property and get 30-year fixed. You're getting 30-year fixed, you can still cash flow very easily in today's market because interest rates aren't that high if you're talking historical averages. So shop banks, get an amortization schedule longer if possible. Number 3 is charge market rent or close to it. If you have tenants in there, or you're going off your previous, if you had a tenant in an area for 2 or 3 years and you get a new house in that area or a new rental in that area and you're charging the same rate, you are losing hundreds of dollars a month, not a year, a month. Rental rates have gone up drastically. Similar to that chart I drew earlier, rental rates have increased like crazy. Now, I like to give my tenants a good deal. I like to make them feel like they're getting a good deal by giving them a good deal, treating them fairly, all these things. So I'm usually 95% of market rent, probably closer to 90. So if market rent on a property is $2,000 a month, I'm charging $1,850. So I give them a little break. They stay longer. However, that example, that $2,000 market rent, if you haven't looked at rental rates recently and you have properties that you haven't updated or that you haven't updated the rentals on in a few years, you're probably charging $1,500, if not less. Rental rates have gone up a ton. Now, you don't want to screw over the tenants by giving them more than they can afford. So just approve of tenants that can afford the market rental rate or close to it. That's huge. If you get the lowest interest rate possible, if you're scheduling out to 25 years and you're getting market rate and it's a good deal, I am very, very, very confident that you can still cash flow a few $100s a month, if not more, like you could before. Because before, nobody was charging the max market rate. Nobody was. You weren't. I promise. You can think you were, but you weren't. Everybody was like, cash flow is $300. I'll just charge that or whatever. So, and they're not keeping up with the rental rate increase. So charge and rent market rate when you're running your numbers, extend out the terms as long as possible and shop the rates, you will be able to get several $100s. That's aggressive. So you'll be able to get at least a few $100s more than if you just did what you were doing before. So those are extremely important ways that you can utilize to increase that rent, even on your long-term rates. And the fourth one I want to talk about before I get into some different actual strategies, like we're talking like midterm and short-term and long-term, those different strategies. The fourth one is long-term mind. Somebody said the other day, like, I can't read your writing. I'm leaving the live, and I'm like, giving you away thousands of dollars information. My writing sucks, but get over it. All right, so long-term mindset. Rental properties are going to go up in value and down in value Every rental property you own, I suggest having the mindset that you're going to own it for 25 years, if not your entire rest of your life. So over a 25-year period, that value is going to go up. It's going to go down. It's going to stay flat. It's going to do crazy things. But if you're not looking to sell, it does not matter. Let me repeat. It does not matter the value of your rental property if you're not looking to sell, unless it gets cut in half, which it will not do again. Nobody's calling for that. Unless it gets cut in half, no, even if it gets cut in half, not all banks are going to call your note due. So if you're not looking to sell, it doesn't matter what your actual property values are worth. Once you refinance or sell, who cares? So don't worry about that, and just understand that over time, things shift, markets go up, they go down. Like over a 25-year period, you're probably going to make, I don't know, 400 to 500 grand per property. If we're talking increase in value, debt pay down, as well as cash flow. It's probably $500,000 per property over a 25-year period. So you get 5 properties, you got $2.5 million in 25 years. So just understand the long-term mindset. All right, now let's get into what? Not right now, maybe. Throw a question in the chat box if you have them. But let's talk about the different types of tenants. So there's long-term tenants. Speaking of the word long, Jaden knows nothing about that one. Then there's mid-term tenants. And then here, this is the Jaden one, short-term tenants. That's Jaden. Let's write a J with a circle by that. That's Jaden, short-term. All right, so long-term tenants are tenants that stay for a year. They sign a year lease. They sign a 2-year lease. They stay for a long time. That usually is the lowest amount of rent you get because it is a long-term tenant. They're staying for a long time. They're committing to a year, so you get the minimal rent per month. Midterm, we're going to come back to, because this is where I think you can adjust right now in today's market to sell cash flow. We have people doing it right now. Short term, you get the most because you're renting it by the night or the week. Usually not the month. It's usually by the week or a couple nights, 3-night minimum, something. You can get the most amount for that. So that's great. So adjust to short-term rentals right now, and your cash flow will 10x. Our apartment complex unit for us cash flow is like $150 a month. We turned one of those into a short-term rental, and now it cash flows like $1,500 a month. So it literally is 10xing its cash flow, like net to our pocket, because we're renting it by the 2 or 3 nights. So that's a great option. If you don't want to furnish it, can't furnish it, or it's not in an area where you can have short-term rentals, you can probably have the midterm rentals, which is kind of the best of both worlds. I don't know why I put equal sign, but I did. Kind of the best of both worlds. We just had one of our coaches of our mentorship, Kayola, just do this. The day he listed his property, it's not in a short-term rental area. It's in like a neighborhood or the city. It's just like a normal rental house, and he's renting it out to traveling nurses. So these are traveling nurse rents. These are corporate rentals, insurance. You know, if there's something that happens, and insurance agents need to go out and be in the area if there's like a flood or like a windstorm or hailstorm or earthquake or drought or whatever it may be. People are traveling a lot and need to stay for 2, 3, 4, 5 months at a time. Long-term tenants, landlords won't lend to them. Short-term, by the night, that's too expensive. So there's these mid-term options. He literally, KO put his house on the market, and he got full asking per month for 3 months the day of with a traveling nurse, and there's programs that approve them and fill them and everything. It's super, super easy, and he's getting, I think, 30% more. So let's say market rent was $1,000, he's getting $1,300 for 3 months, guaranteed, all paid up. And that allows them to cash flow $450 rather than $150. So that midterm in pretty much any area does work, because usually the laws for short-term rentals are they have to stay at least a month or something like that. So if they're staying for 3 months, there's usually no laws against that. So those are some options for you. Let's get to a couple of questions, and then we will skedaddle out of here. Any good questions on there?
So can you explain more about the extending amortization?
Yes. So somebody asked about the extending amortization I talked about earlier. So when a property is amortized, it's usually your traditional house is over 30 years. So you're financing $100,000 over 30 years, your monthly payment is going to be very small. If you finance $100,000 over 15 years, then your payment's not double, but it's going to be more because you're paying that whole amount in a shorter period of time. So what I was saying was extend that as long as possible. Many people just do 15 or 20-year amortization schedules to get it paid off quicker. Cash flow is not as much, they're not important. Those people extend that to 25 years and 30 years where possible, so you can pay less every single month and still cash flow.
All right. Does the BRRRR method make sense in today's market?
Does the BRRRR method make sense in today's market? Yes, it does. I have students that are doing BRRRR deals every single day. DM me on Instagram if you want my free training on how the BRRRR method still works in today's market. So Other than that, we're good. I got to get ready for the other thing we're doing here in a minute. So thanks for being here. Get us off of YouTube, Insta, Tiki. See you on the next